Hi, I'm Nick Brocheta, FX Doctor. Today we will talk about technical analysis, charts, trends, support and resistance, and the basic principles of technical analysis. Okay, let's start. Uh, Charts, technical analysis, charts. One of the essential tools for every currency trader is the chart. Chart displays the historical movement of currency exchange rates within a coordinate system. By analyzing charts, traders observe past market trends and, using the principles of technical analysis, attempt to forecast future price movements. The four key price levels in each trading interval are open, close, high, low, as you know. Okay, three basic types of stock charts are line chart, bar chart, and candlestick charts. We will talk about each of them. Line chart displays a simple line connecting closing prices over a set time period, showing the overall direction of the market. Bar chart shows the opening, high, low, and closing prices for each time interval using vertical bars. Candlestick chart similar to the bar chart but uses colored candles to visually highlight bullish or bearish momentum. Okay, we will talk about each of them. This is a line chart, bar chart, and candlestick chart. Okay, let's get back. Okay, we have also Heikin Ashi chart, a variation of the candlestick chart that smooths price action to better identify trends and reversals. Renko chart focus on price movement rather than time, plotting fixed size bricks only when price moves by a set amount. Point and figure chart ignores the time and focus solely on price changes using X and O's to represent rising and falling prices. Okay. One of the most popular chart types used in technical analysis is candlestick chart. Each candlestick represents price movement over a specific time period. Okay. Let's say if we have time frame 1 hour chart, each hour, if this is green or white, it is bullish candlestick. That means that hour opening price was here, closing price was here, but in that time frame price went down here and up here. And in the other direction, bearish candlestick, price opened here, closed here, but in that time frame goes here and goes here. Okay. Uh, okay, this is a line chart. It connects all closing prices in that this is euro dollar, uh, our chart euro versus United States dollar closing prices, as you can see. Same thing with bar chart, but bar chart gives us more information in that time frame. Let's say this is 1 hour. Every bar represents 1 hour. 1 hour, and we have opening price, closing price. This, for example, this hour is shown by one bar. Opening price is on the left side, closing price is on the right side. And in that time period, the price went here and went here. The same thing is with candlestick chart. But as you can see, this chart is visually more attractive for traders. White candlesticks are bullish and black are bearish. As you can see, opening price, closing price, highest price, lowest price. Opening price, closing in this candle, or closing price and lowest price are on the same level. As you can see, there is no shadows. Okay. Technical analysis is a set of methods and techniques based on the historical price movement of a currency pair used to draw conclusions about future price direction. The principles of technical analysis can be equally applied to forecasting price movements and all financial instruments, not just currencies. Core principles of technical analysis. There is three core principles. This is very important for you to know. There is three core principles of technical analysis. First is the market discounts everything. All available information, economic, political, psychological, is already reflected in the price. What that means? All the data, let's say if we are trading stocks, we are we are analyzing some company, some cash flow analysis, I don't know, statements analysis, ratios, I don't know, and this market continuous everything principle is saying that all of the informations are through the market, through the market already in the price, and all we need to do is just to follow and analyze the charts and the price movement, and all the informations all the informations are already in the price. Okay, let's go further. Price moves in trends. Prices tend to move in the identifiable trends. Once a trend is established, it's likely to continue until it reverses. That is, trend is your friend. That you heard that. Always try to trade in the trend direction. History tends to repeat itself. Market behavior is often repetitive due to investor psychology. Patterns and movements seen in the past are likely to appear again. Okay, you will see all of this. That this is the basic truth of trading. Trend is your friend. History repeats, and the market discounts everything. Okay. Market discounts everything. Technical analysts believe that the effect of all factors influencing a currency pair, whether economic, political, or psychological, is ultimately reflected in price movement. The market reacts instantly to any new information and incorporates it into the current exchange rate or the stock price. Therefore, the only truly necessary input for analysis is price action itself. Price moves in trends. This principle is based on the concept of price inertia. Just like Newton's first law of motion, once a price starts moving in a certain direction, it tends to continue in that direction rather than reverse. Prices rarely move in straight lines. Instead, they fluctuate with smaller or larger corrections along the way. These oscillations are normal, but it's essential to always recognize the overall market direction, known as the trend. The trend is your friend. Traders must constantly be aware of the current market trend. The role of technical analysis is to identify the trend, estimate its duration, and detect when a reversal might occur. Trading strategies should always follow the trend until clear signs of trend reversal appear. And the third principle, history tends to repeat itself. Technical analysis is closely connected to human psychology. People drive the market, and the price movement reflect their collective behavior. Exchange rates often move in ways that mirror how traders emotionally react based on their expectations and assumptions. Over time, certain recurring chart patterns have been identified. These patterns are considered visual representation of crowd psychology. They either signal to trend continuation or a trend reversal and are known as patterns or formations. By studying these patterns, traders attempt to predict future price movements. Knowledge may change, but human behavior is stubbornly repetitive. While individual traders may have a little market impact, the collective behavior of all participants creates consistent natural price movements. Many believe these market dynamics follow laws as reliable as natural phenomena. Psychology factors in trading's two dominant emotions drive market behavior. It's fear and greed. Fear leads to panic selling, hesitation, and missed opportunities. Traders often exit positions too early and avoid entering the market altogether. Greed causes overtrading, chasing the market, and holding losing positions too long, often leads to irrational decisions and ignoring risk management. Successful trading requires emotional discipline. Mastering your mindset is just as important as mastering your strategy. Okay, greed, fear. Market is not casino. Trading is not gambling. The financial markets are not Las Vegas and should never be treated as such. Trading is a business, not a hobby. You must manage your capital, costs, and returns just like any serious entrepreneur. You decide how much capital to invest. Never invest more than you can afford to lose without affecting your lifestyle or financial stability. Rule number one. Only trade with money you can afford to lose. Start by trading on a demo account. Once you become consistently profitable on demo, then move to a real account. Avoid investing large sums at the beginning. Focus on learning, testing, and building discipline first. Income in this business comes from profitable trades. Traders open positions based on their expectations of price movement, whether upward or downward. Profit is earned when the market moves in the anticipated direction. To generate consistent income, a professional approach is essential. A professional mindset means strict discipline, clear strategy, risk management, and above all, 100% concentration at all times. Trading is not passive, it requires active, focused engagement. Okay, you heard about bulls and bears, and you know this, but let's say again, bulls are market participants who want prices to go up. They aim to push the market to higher highs. Bears are those who want prices to go down. They aim to drive the market to lower lows. There is a constant battle between bulls and bears in the market. When bulls are in control and prices rise, we call it a bullish market. When bears dominate and prices fall, we call it a bearish market. Okay, support and resistance. Support and resistance levels. When the price falls and reaches a level where demand exceeds supply, the price tends to be bounced upward. This level is known as the support line. As you can see, prices are falling down, and when they come to this particular price, they're bouncing up, as you can see, and this is support level. When the price rises and reaches a level where supply exceeds demand, the price tends to reverse downward. This level is known as a resistance line. As you can see, this is resistance. Price is going up, going up, going up. For example, let's say Bitcoin was 100k. That price was resistance. But when it was broke, when that level was broken, the price went up really hard. These levels act like psychological barriers in the market where many traders make buy or sell decisions. Types of market trends. Every price movement in the market occurs within a trend. There are three main types of trends: uptrend, downtrend, and sideways trend. At any given time, one of these three trends is always present in the market. Uptrend is a series of higher highs and higher lows. It's a bullish movement. Downtrend, a series of lower highs and lower lows, bearish movement. And sideways trend, price moves within a horizontal range without a clear direction. We will talk about that. Uptrend, higher highs, higher lows. This is the definition of uptrend. When uptrend is present, we are making our decisions, we are waiting for the retracements, and we are putting like this, we are opening buy positions. Oh, I think that we can do something like that now. Okay, just a second. Okay, as you can see, this is gold hourly chart. As you can see, this is uptrend, and we have this trend line, and the price bounces from this trend line, as you can see here. 1, 2, 3, 4, 5, 6, 7. Now we are waiting for price to come here to buy gold, and I will do that until we will talk about this in script, and we will check it for this. We can make also alert here, or we can make this. Okay, I made this buy limit. When the price comes here, we will buy it. Okay, but we will talk about that later. Let's do the script. Okay. Downtrend, falling trend. Characterized by lower highs and lower lows, indicates bearish sentiment, sellers dominate. Traders look for sell short opportunities during retracements toward resistance. Every up retracement, we go sell short, it's and sideways trend, range bound market. Price moves within a horizontal range without clear direction. Neither buyers or sellers have control. Traders often use range trading strategies. Buy near support, sell near resistance. Okay, that is something like this, I think. Just a second. This is it. Buy here, 1, 2, 3, buy here, buy here, buy here, or after 1, 2, sell here, sell here. That is channel trading. Okay. Okay, trend line. Each touch of the downward trend line is a potential entry point for a sell position. Break in the downtrend, trend line signals a possible reversal of the downtrend into an upward trend. As long as the price stays below the trend line, the downward trend remains active. Breaking through the trend line can be a good entry point for a buy position. Okay, 1, 2, 3. This is a sell position. 4. This is a sell position. Okay. Support and resistance. Yes, this is support and resistance. Resistance level is the point where the bulls are overpowered by the bears. The resistance line is a psychologically significant level where many participants anticipate a trend reversal and expect the price increase to hold. If the bottoms of multiple consecutive waves end at the same level, that level is called the support level. The line connecting the bottoms of waves at the support level is called the support line. For a super line to be valid, at least two bottoms must be lie at the same level. This is a one, two, two. This is three. You can buy here. You can buy here. You can buy here. You can buy here. Okay. Resistance level is formed when multiple wave peaks reach the same price level. A resistance line connects the peaks of waves at the resistance level. For a resistance line to be valid, at least three peaks must lie at the same level. At least two. This is a mistake. At least two, like this. One, two. You can sell here, sell here, sell here, and that's it. Okay. Yes. If the price moves and first week, okay. This is support and resistance the same. One, two. 1 2, this is place for sell, but if the price breaks support or resistance, you use that. In this particular case we go sell here, in this case buy here, but we will talk about that later. Okay. Okay. Okay, this is support, this is Amazon, but this is old chart, old photo from 2006. Okay, one, two, this is buy place. Okay, and breaking, we have breaking, the resistance line, one, two, three, four, five, and this is place for buy. When the resistance line is broken, we go buy. Sorry. Okay, we'll just say this core principles of Dow theory, and we will stop there. After that, we will have continuation patterns. After that, the reversal patterns. Okay, but for now, okay. Core principles of Dow theory. Market discounts everything. Market moves in three trends. Each primary trend has three phases. Trends must be confirmed by the different indices. Volume must confirm the trend. A trend remains in effect until it gives a clear reversal signal. Okay, and we will talk about that when we start to talk about these patterns, continuation patterns. As you can see, triangles, triangles, ascending triangles, descending triangles, and how we measure them, and reversal patterns, head and shoulders, reversal head and shoulders. Yes, as you can see, triple top, triple bottom, double top, double bottom, and later on. Okay, just to check this. Okay. Price is still here. Okay. Thank you for watching, and I'm looking forward to patterns. That's it. Goodbye.